How to save money in retirement. Hello and welcome to Videojug. I'm Paul Lewis and I've been a financial journalist for more than 20 years. I'm going to talk to you today about saving money in retirement, because when you are retired, one of the things you find is your income goes down, but in a strange way your spending might go up because you've got all that time to fill. So saving money in retirement is a very important thing to think about. Step 1, keep track of spending. Now, there's a danger here. I'm going to be teaching my grandmother to suck eggs. I'm sure you've been doing all this all your life, but just indulge me. Just listen to what I have to say for a minute. Keeping track of spending is the most important thing. There's an old trick when you want to lose weight. You write down everything you eat, and just the act of writing it down makes you think, I'm not going to eat that because I don't want to write it down. I don't want to admit it. And it's the same with spending. Writing things down helps you understand where the money goes. All of us have been to a cash machine and got out 30 or 40 pounds, and 2 days later it's gone, and you think, where on earth did that money go? So write it down and then you know. Step 2, look after the pennies. Now, however much you spend, it's going to start with small amounts. It's that daily cappuccino, which is £2. It's the newspaper, which is 70 pence. It's the bus fare, the train fare. It's the things you do every day that build up to cost you a lot of money. And certainly if you're in work and you're preparing for retirement, every pound you spend on your way to work is like a pay cut of £336, because you're at work more than 200 days and you've got to pay tax on the money to have enough to spend it. So it's like your 336 times table. If you spend £1 a day, it's a pay cut of £336. And that £336 you could be putting into a pension, saving for your future. And when you have retired, it's those daily habits that eat away at the money. Everything you spend, you could start thinking about saving. Don't buy food or coffee when you're out. Always take it from where you are, make it at home, take it. Don't buy a newspaper every day. They're free in the libraries. And when you go out and when you do your shopping, look for cheap things, not old things, not things that are out of date. If you go to the supermarket, it can cost you twice as much to buy vegetables in a plastic box than to buy them loose and weigh them yourself. Step 3, change banks. Now, I've talked to you about spending less, but you can also save money in other ways. You can spend less on your bank, and you can make your bank give you money. Banks are there to make profit, and last year the big 5 high street banks made nearly £40 billion profit, and a lot of that was from the retail customers, you and me, keeping our money there, getting no interest on it. So always make sure that your bank is giving you the best deal you can get. And don't feel any loyalty to them. They feel no loyalty to you. Just because you've been with a bank for 20 or 30 years doesn't mean it's the best deal. In fact, it almost certainly means it's the worst deal. So here are things to look for. Your current account, your day-to-day money, is it earning interest? If it's not earning 4 or 5%, move it. And believe me, it won't be earning that much with most of the high street banks. It probably means you have to go online and do your banking online. Don't worry about the security. It's just as safe there as it is anywhere else. And if there is a problem, you do make a mistake, then it's the bank that will bear the cost, not you. So don't worry about that. The second thing is your savings, not the money in your current account, the money that's coming in and out, but money that you've got saved up. Make sure that's earning a decent rate of interest. And at the moment, that should be at least 6% a year. In future years, it may be more. It depends what the Bank of England decides. But it's got to earn that interest. And you should check the rate of interest every year, every 6 months if you can bear it. Because what the banks do is they tempt you in with tempting offers, and then the rate of interest is slowly brought down till you're only earning 2 or 3%. So check the rate of interest and move your money. And as I said, don't feel loyalty to your bank. They will feel no loyalty to you. And the third thing is, don't go overdrawn. Now, there's been a lot about overdraft charges in the newspapers over the last year or two. The safest way to avoid those charges is not to worry about whether they're legal or not, what the courts will decide, but simply to worry about not going overdrawn. Watch your money, manage your money. It's much easier online to do that too. And if you think you'll go overdrawn, immediately contact the bank and tell them. Try and arrange an overdraft, then at least you'll avoid those big penalty charges. Step 4, cancel life insurance. Now, this is a controversial one. Most of our life we're encouraged to buy life insurance, but you only need life insurance if you have dependents. If you have children or a dependent wife or husband, then yes, you need insurance so that if you do die earlier than expected, they will have some money. But once you reach retirement age, really, is anyone financially dependent on you? If they're not, you do not need life insurance. So why pay 10, 20, 30 pounds a month for something you don't need? The question to ask yourself is, if I died tomorrow, would anybody suffer financially? And if the answer is no, or not very much, then cancel that life insurance. It's a drain on your bank, and once you reach a certain age, you don't need it. Step 5, say no to warranties. Actually, I'm a bit against a lot of insurance, but warranties are one of the things that I'm really against. They're the kind of extended warranty you're offered. You go into a shop, you're persuaded to buy a product, brilliant product, does exactly what you want, electronic product or a fridge or a cooker, and then just before you sign for it, you're asked, would you like to take out an extended warranty? So if it goes wrong in the next 5 years, we'll pay you some money. These products are almost always a complete waste of money. First of all, modern products don't go wrong very much. Secondly, the retailer is responsible for that for the first year anyway. So if it goes wrong within a year, you can take it back and get your money back. And beyond that, many manufacturers offer 2 or 3 year guarantees on their products without paying anything. Warranties are a waste of money. Step 6, energy saving. One of the big bills that affects people in retirement is the cost of heating and lighting their home. Other things you can control, but somehow that bill for the electricity and the gas just seems to keep going up and up. At least it has over the last few years. So it's very important that you do take the steps to switch your supplier. There's lots of ways of doing it online. You can find the sites that help you change from one supplier to another. To be honest, they're all much of a muchness. They should all give you the same answer. Go onto them, find one that suits you, ask 2 or 3 of them if you don't believe that they're all the same, and go for the cheapest energy supply. Gas and electricity, and it may be that it's better to have them separately rather than together. Step 7, direct debit. Now, not everyone's a fan of direct debits. I must say I am. I use them a lot. I'm a fan for 2 reasons. If you pay by direct debit, you don't miss payments, so you don't get penalised, and things like credit cards still charge you a penalty if you miss the payment on them. The second thing is that direct debits are often the cheapest way to pay. If you want the best gas or electricity deal, you've got to go for direct debits. And nowadays, even your phone bill and other utility bills are cheaper if you pay by direct debit. Step 8, sort out debts first. One of the features of getting older, of heading for retirement, is that people will try to sell you savings products, financial products, whether it's a pension or just a savings account. There's one golden rule with saving and investing. Don't do it if you have debt. Sort out your debts first, because once you retire, you're going to have less income. It's going to be harder to sort them out then. Suppose you've got a credit card and you owe £1,000 on it. You might think, oh, I'll just pay the minimum. If you pay the minimum on a £1,000 debt on a typical credit card, it will take you 21 years to clear that debt. So don't ever pay the minimum. Start paying as much as you can to bring that debt down. Get rid of your debts, and then you can start thinking about saving or investing, because the money you're charged on a debt will always be far more than the money you will make on an investment. Step 9, say no to instant credit. Actually, say no to credit generally if you can. It's always better to buy something from your savings than to borrow money to buy it. Instant credit, especially those deals that say pay nothing now, don't pay anything till 2010, really they're all tricks. If you follow the rules to the letter, you might get free credit. But really, credit is something to avoid as you head for retirement, not something to take on. So say no to instant credit, Say no to credit in the shops, because the problem with shops is they will always want to sell you the credit because they've cut the price of the goods to the bone. So they then want to sell you other things to make their money. Their credit is going to be more expensive. If you have to borrow, well, you could get a bank loan, you could even use your credit card. But as I say, the best place to borrow money from to buy something is yourself. Use your savings. It's going to be the cheapest way, and you're much less likely to send in the bailiffs if you can't pay it back on time.